It's interesting. My friend Mike McGlone at Bloomberg has been pretty consistent in sort of making the point that you just made, which is that if you look at commodities, they're somewhat sort of inherently deflationary through all of this. Is that it's just not really happening. And then you look at gold, which is basically at a 0% return over the last year, right? And it
Yeah.
makes Bitcoin look like such an astounding trade when you take that in context, since a lot of people view it as a sort of a commodity or hard asset, as you discussed, and not as a currency. But what you're saying is that inflation will continue, and we just don't have the high bar that was so absurd over the last year. It kind of makes you shake your head when you think about it, because even if inflation is far greater than it was a year or two ago, people view it as a positive that it's not as bad as when it was the worst, right?
Exactly. Yeah.
So, I mean, what does that mean for Bitcoin moving forward, do you think, if that in that environment?
But I think if this negative real yield environment continues, then it should be continually be good for assets that have some degree of scarcity. And so if you look back with even the past 10 years, so the longer end of the Treasury curve generally had yields that were at or above the official CPI inflation rate, at least, whereas T-bills were below the inflation rate for most of the past decade. And so now going forward, both T-bills and T-bonds have their yields that are below the official inflation rate, let alone any imperfections in that inflation rate to kind of truly capture real inflation. And so as long as that persists, that is pretty good for real assets. And I think that, Bitcoin is one where, the majority of the world can access it, right? So not everyone can access stocks, especially in emerging markets, right? But anyone with a smartphone, which is something like 4 billion people now, can access Bitcoin. And so, some of the most inflationary effects are not even in developed countries. And so, right now, the lowest areas of inflation are in places like Europe or Japan. Then you have higher inflation in the United States because we increased our money supply at a faster rate. But then when you go out into a number of emerging markets, they have higher levels of inflation, and those are environments where, I think that there's a much easier case even for holding Bitcoin. I think the case is really good in developed markets. But for example, if I was in Turkey, if I was in Argentina, if I was in Brazil, if I was in any number of these countries, as volatile as Bitcoin is, it's more attractive than holding large amounts of the local currency. And so I do think that that these forces will be continually beneficial for the protocol over the next 5-10 years.
Do you think that we could ever see that hyperinflationary environment in the United States?
So my base case is not for something like hyperinflation. There are kind of outcomes where it could happen. It's a non-zero risk. So that generally for hyperinflation to happen, you need a couple of variables. So we see it often in emerging markets. It's exceedingly rare in developed markets, and that's for a couple of reasons. One is, there is a large amount of debt out there, and that debt kind of represents demand for that currency. Because when you have dollar-based debts, the only thing that can extinguish that debt is a dollar, and so there's debt in the United States. There's also at least $12 trillion of foreign debt that is based in dollars, let alone all the debt they have in their own currencies. And so there is this kind of persistent demand for dollars and for euros and for yen. The second thing is that when you look at hyperinflations of the past, generally it's if you look at emerging markets, they often have obligations that they can't print. So they have, say, dollar-based debts, even though they're Argentina and they don't have a way to print dollars or acquire dollars, and so their local currency ends up hyperinflating as they risk default, as they risk kind of a financial crisis. The second case would be, say, like a country that lost a war and that their productive capacity was extremely damaged, like Germany, or if you do social practices that can badly damage the productivity of a country like, say, Zimbabwe. And so, apart from those extreme events that really kind of collapse the productive base, it's hard to get hyperinflation in a country that controls its own currency. Now, that is, especially because hyperinflation is defined as 50% inflation per month, which is basically currencies quickly becoming useless. So even by that metric, even something like Argentina is not hyperinflating. It's just having super inflation. It's kind of rapid inflation, but not hyperinflation. And so the United States, if you look back in history, the highest inflation we reached was about 20% year over year, which is obviously quite problematic, but it's nowhere near
Right.
50% a month. And so I can envision environments that are say pretty high inflation, but you'd have to do something structurally pretty problematic in order to get hyperinflation in one of these developed countries. You'd have to destroy the productive base enough that currency becomes rather worthless.
So that makes perfect sense. So I'm curious for your average investor. I know you do a lot of educational work, and we've always seen this sort of structure in the United States. You get your 401k and it gets matched by your company, or you invest in your Roth IRA and equities, and you assume that 40 or 50 years down the road you'll have accumulated some wealth. Do you think that that's a viable approach for people investing in Bitcoin and cryptocurrencies? Do you think that timeline and that sort of historic approach is correct?
You mean if they start, for example, including crypto
dollar cost averaging in Bitcoin for 30 years, or in other assets, or if you have a self-directed IRA, putting it into those classic vehicles, something like that?
I think so. I think for most people should not be professional traders, whether it's crypto or whether it's traditional assets like stocks and bonds. And so generally the best approach is dollar cost averaging over time. Now, the difference between something like an S&P 500 and Bitcoin is that, Bitcoin's a single asset. You're betting on, the adoption of this specific network. And so, for example, I'm generally not one of the people that argues that people should put 100% of their net worth in Bitcoin or other cryptos. But as a slice, maybe owning their own home, maybe having an equity portfolio, maybe having some commodity investments, whatever they are knowledgeable in or bullish on. I think that dollar cost averaging into something like Bitcoin, in addition to those other slices, can be an important part of, say, a long-term strategy, as long as they're continuing, to be bullish on that network.
Yeah, I want to go back to the other conversation a bit about hyperinflation, about the United States. Obviously, there's the famous sort of analogy. Taleb always touched on it. You light small fires to prevent the big fire, right? To clean out the underbrush and all the things. It seems like our governments never learn, right? We keep doing it, crash, repeat it all again, crash. Do you think that we have an inevitable black swan event coming at some point again because they haven't learned their lesson and are basically repeating the same behaviors of the past? Or can stocks really just kind of always go up and they can continue this path?
There's a couple factors. So one is, I think 2020, as you point out, was a good black swan because it shows, not only what a pandemic can do, but it's also specifically what any sort of disruption can do to a system that's this highly levered. And so it wasn't specifically necessarily the pandemic that caused a lot of what we saw. It's that people had so much debt, companies had so much debt, and basically, so any disruption to cash flows results in rather quick insolvency. In addition, because the United States has run structural trade deficits for so long, we built up a deeply negative net international investment position, meaning that the foreign sector owns more U.S. assets than Americans own of foreign assets. And that includes, for example, the foreign sector owning a large amount of treasuries. And so when there was a dollar shortage during that period in March, the foreign sector had to sell some of their U.S. assets, including treasuries, in order to get dollars. And so what we saw, for example, was the treasury market became illiquid. It literally broke. And so it's funny for anyone watching. Basically, it's one of the most liquid markets in the world, one of the deepest markets, one of the most kind of safe markets. And there's essentially massive bid-ask spreads in that market. It basically was essentially a broken market. And so the Federal Reserve had to come in and buy $1 trillion worth of treasuries with new bank reserves in a 3-week period. And then they slowed it down after that. But basically, they had to reliquify the treasury market. And so that shows an example of kind of how these systemic things have built up. We have such high debt levels. We have such large kind of dislocations in net international investment positions that these sort of disruptions can result in kind of, the requirements for massive, kind of responses. And so overall, there's a couple kind of tail risks that could end this. So one is this whole kind of post-2008 period of basically constantly increasing central bank balance sheets, of running these sort of policies, is that we've been in generally a commodity bear market for this whole time. And so for anyone familiar with the commodity market, you go in big cycles, right? So there's too much supply brought online. So you get a crash, and then eventually there's not enough people investing in the space, and so eventually demand catches up to supply. Prices go up, more people come into the space, but then they overbuild and it kills the price. And so from the early 2000s up till 2008, we were in a pretty strong commodity bull market. And so when we had the global financial crisis, that kind of damaged the oil market. It rebounded a little bit for a while. Copper kind of hit a peak, I believe, in like 2012 back then. So it was a little bit later. There's kind of the China's growth rate started to kind of slow down after that, and so that kind of resulted in a weaker commodity environment. And so ever since those few years, especially since 2012 for copper, especially since oil kind of fell off a cliff in 2014, we've been in a weaker commodity environment. And so that's actually been a pretty strong deflationary force that has allowed for a lot of this kind of money printing to occur. Now, if you were to try the same thing in a decade where commodity markets are a lot more tight, well, you could quickly kind of run into more stagflationary problems, or have inflation running hot. Even different ways of measuring it. Even if you kind of measure it in a way that's not perfect, it's enough inflation that even those metrics are showing pretty high inflation, like we're seeing now with, say, 5% year-over-year prints.